Everyone. Welcome to Evergreen Academy, the School of Building Economic Streams. Welcome to our course, Understanding Financials.
Welcome, everybody.
In this course, we'll cover the financials, or you may have heard them called financial statements. These include your balance sheet, your income statement, and your statement of cash flow. We'll review them at a high level to ensure everyone that'll be taking this course, as well as other courses, has a basic understanding of this content and purpose.
Oh, goody. You're going to let me teach?
Along the way, we'll also share some lessons learned related to preparing, managing, and understanding each of these statements.
What do you mean by content?
Let's get started, Pepper, and then we'll show you what that means as we go through the course. Just a reminder to all you taking the course, this may be a reminder for some of you. However, it's a great foundation for all the rest of our courses at Evergreen Academy.
So that it is for everybody, right?
Exactly.
Then why didn't you just say that?
Pepper, quiet.
I'm just saying.
Hey, Pepper, I think somebody's looking for you. Why don't you go take a look?
Okay, I'll be right back, okay? Don't go nowhere.
Although we tend to use the term financial statements, in reality, it's three separate documents: the balance sheet, income statement, and the cash flow statement. We'll first start with the balance sheet. It's essentially a document that reveals your financial status of your business overall. Unlike your other statements, your balance sheet isn't for a specific period of time, it's for the overall life of your business. Your income statement and cash flow statement are for a specific period, say 1 year. During this course, we'll go over the primary areas or categories on each one of these statements, but keep in mind, for your specific business, the terms may change, but the overall layout will remain the same. So let's start with current assets. These are your assets that can quickly turn to cash. They're called liquid because essentially they can turn to cash very quickly.
Liquid? Why you want liquid? Won't that mean that everything gets wet? I wouldn't do that. I mean, you got everything there. It just gets wet, and then you got real problems. I don't understand.
No, Pepper, liquid doesn't mean like water. It just means that it can be converted to cash very quickly. Cash is at the top because there's no conversion. Accounts receivable is next because it typically just means that you have to just go out to your customers, send an invoice, and within 30 or 60 days, depending on your payment terms, your cash should be coming in.
Ah, got it.
Large organizations may use different names for this category and split it up into various product lines or services. As your organization grows, you may want to do that so that you can quickly look and see how each product or service line is doing. However, regardless of the size of your company or the business model or the services or products that you're distributing, everybody should pay attention to this area because it really starts to indicate how well you manage your resources, especially around collections. Similar to your people, Pepper, who tend to pay a little slow. You may want to adjust the credit terms or hold back supplying until accounts are current, but it all depends on the business and relationship with your customers. In this area, it'll include your accounts receivable or money due from customers.
Okay, I think I got it now. I understand the liquid part, but I understand one thing another. My people, they're not liquid. I understand liquid, you know how you explain it, but no, my people,
Exactly, Pepper.
I got special people.
Yeah, you have special cases, Pepper.
Oh, they got, they just different. They just, they think liquid. Then that maybe it's not so liquid. Maybe they're more like ice cubes. They just need time to thaw. They thaw and then the money flow.
Again, this current assets section will change depending on the type of business as well as the size of your organization. However, all organizations should have cash first, accounts receivable second, and then you can build from there. The next section are your long-term assets. All this essentially means is that it takes a longer period of time to convert these from their current state, property, maybe plant or equipment, into cash.
I don't think I have a lot. No, no, I got my business superhero, so I thinking, okay, I got my bow, I got my arrow, I got all my capes, but I leap over balance sheets at a single bound, so I don't even really have a building because I don't stay in one place. So at this point, I don't have a lot, but you know, I may need superhero other items a bit later.
You're exactly right, Pepper. For most organizations, when you start out, you won't have a whole lot in this area. Mostly phone, your laptop, and possibly a desk. Items that you would normally expense, but they're not a big cost item, so you wouldn't have them in under property, plant, and equipment. However, depending on the company, if you have a photography business, for example, or a salon where you have equipment that is costly, you'll have this. You want to keep track of this, so you'll need to have this section for property, plant, equipment, because for photography, you'll want your lights and all your other equipment that you use in your business that'll depreciate or reduce cost over time. But these are high cost items, a couple of $1,000 that you'll depreciate over a period of
What's the
time.
point of this section? I get the cash, but I don't get this section. What's the point? Why do I need it?
Someone may be asking, what's the point of this long term assets section? Essentially, what it means is that all your property, your equipment, for example, has a high value. And if something should happen to your organization where you need cash, you could code sell this property or your plant or your equipment, exchange it for cash, and pay off your debt. So it more or less shows how you have value, how you have cash or you have money in your business. But again, if you're a small business starting out, you're probably not going to see a whole lot in this area. But as you grow, you'll acquire property, you'll acquire more expensive equipment. And again, depending on the business model, if you're a photographer or own a salon or some other kind of business like landscaping, you have equipment that has value. And what that essentially means is when people look at your company, say you want to take out a loan, you can show, like, hey, I have some equity in my own business that I could put up as collateral, this equipment. So if I can't come and pay off the loan, if something happens financially, I can come up with the cash to be able to make the loan payments. But that again, we'll talk about finance management under the financial house. You don't want to always do that. And we'll get into that a little bit later. But just so you know, this actually represents all the assets that your company or your business owns at this point in time.
I think I got it. Like I say, I leap over balance sheets at a single bound, and so I don't stay in one place. But leaping that gets tiring after a while. So I could be like Batman later, and I get a car, and then I drive around, from balance sheet to income statement, and then
One exception to all this is your accumulated depreciation. Accumulated depreciation really isn't cash, it just shows where the value of your equipment is reducing over a period of time. And so, where you may have paid $10,000 for equipment each year, the value, it's no longer worth $10,000. Each year, it depreciates a little bit, like your car, for example. You paid $30,000, but if you go look at the blue book value, it's not worth $30,000 anymore. After the first year, as soon as you drive it off the lot, the value goes down by a couple thousand. So if it's on your balance sheet, you reflect that reduction in the value of that asset. And again, when you need to show how much cash or equity you have, you want people to clearly see the current value in your assets, which is why you show accumulated depreciation under your long term assets.
that's very interesting. That's interesting. Let me think
After this
about it.
section, you'll see a total for all your assets, your current assets as well as your long term assets.
Oh, got
Excuse me,
it.
I apologize. Do you have a question, Pepper? You look a little confused.
Yeah, I keep listening to all this. It don't seem that exciting. I buy something, the value just drops out of it. I mean, I get a nice car, I get a building. It just, I'm driving my car. It's from balance sheet to income statement. Where value
Okay,
go?
Well, let me see if I can help you out, Pepper. Yes, it's not all that it doesn't seem all that exciting. Let's put it that way. But these are the things that you really need to understand, especially when we start talking about in our next course, managing your financial house. You really need to understand, everybody needs to understand their current assets, their long-term assets, and how they need to manage them. So that's why you need to keep a watch on it.
Keep a watch. Do I need to hire security? Big, strong
No, you
security?
don't need to go hire a security guard to keep a watch on it. When I say keep a watch on it, it just means regularly looking at your financial statements. So maybe monthly, maybe quarterly, depending on how much activity you have in your organization.
Oh, yeah, yeah, yeah. I get it. I get it. I get it. I just don't need to look at it every day like my email or like my Instagram. I just need to look at it when I need to do some planning, at least once a month. At least once a month, maybe
One
quarterly,
other
right?
way in which this area is used, Pepper, is to show when it's time to replace some equipment because you start seeing the value because it's a large accumulated depreciation. If you have an accountant, if you have a loan person, they're not necessarily going to take that as saying, hey, you've got equity in your company. You may have to actually purchase that new equipment to bring up the equity, or it's just time to replace it because it's not operating properly to really service your clients.
I see that because I have this car and I'm moving from balance sheet to driving to income statement. But once I hit that cash flow, I need a zooming car. I can donate my old car.
Yes, you can donate the equipment, but just keep in mind that once you donate the equipment, that means that that value, that current value of that equipment gets reduced off of your balance sheet. So it's no longer part of your equity or your company. But that's a whole different topic.
This is so interesting. I mean, I have my superhero business and I've been doing it and I drive from balance sheet, like I say, and to income statement and then I zoom to the cash flow. But I never looked at my financial statements. I just keep going and the money come in, the money flow out. But I just do my superhero. I superhero. I take my arrow, I shoot it, but I don't look at financials.
Yes, you're absolutely correct, Pepper. Most small to medium sized businesses probably won't look at their financial statements on a regular basis unless they're going to get a loan or some other need comes up. But that's why we're doing this course, Pepper, to show people that there's value in watching over and looking at their financial statements more often. And this also goes for larger organizations and managers within those larger organizations that oversee departments.